Stop what you're doing. Close the other tabs. This is not entertainment. This is the beginning of a repricing event that will define the next decade of industrial investment. And it starts with a number most people will never hear until it's already moved against them: 475,000 tons. That's the additional copper demand arriving in 2026 from artificial intelligence infrastructure alone. Not total demand, additional demand, on top of everything else, on top of electric vehicles, on top of grid modernization, on top of the existing industrial base that already consumes 26 million tons a year. Hold that number. Because when BlackRock, the largest asset manager on Earth, with over $10 trillion in assets under management, begins using the phrase "the new oil" to describe a commodity, they are not making a prediction. They are describing a position they have already taken. They are describing a reality they are engineering into portfolios worth more than the GDP of most nations. This is not speculation. This is sequencing. And by the end of this, you will understand why the copper market is about to experience a structural break that cannot be priced in advance, because the market itself does not yet have the infrastructure to price it. Stay with me. Let me start with something that didn't make headlines. In the third week of September, a very specific thing happened in the physical copper market. The premium for immediate delivery copper in Shanghai, called the Yangshan premium, spiked to its highest level in 18 months. Not because demand surged. Demand was actually flat that week. It spiked because a single large buyer attempted to take delivery of 20,000 tons and discovered that only 11,000 tons were actually available. The trade failed. The premium collapsed back down within 5 days, and no one reported it. But here's what that tells you if you know how to read it. The copper market is already operating at the edge of physical availability, not at the edge of production, at the edge of availability. Those are two different things. Production is what comes out of the ground. Availability is what actually sits in a warehouse, refined, graded, and deliverable against a contract. The gap between those two numbers is where this entire story lives. What I'm going to walk you through is the mechanical reality of what happens when a commodity market, built for 26 million tons of annual demand, is asked to absorb an additional 500,000 tons in a single year, not spread across the global economy, but concentrated in a handful of buyers, in a handful of locations, on a timeline that does not negotiate. I'm going to explain why the price you see on a screen has already decoupled from the price you would pay to actually receive copper in your hands. I'm going to show you why the phrase "the new oil" is not a metaphor. It is a description of strategic dependence, and strategic dependence changes how markets behave. And I'm going to walk you through the three outcomes that are now structurally possible, and why only one of them is being priced. This is where it starts. Let me explain what I mean when I say availability is different from production. Imagine a river. Water flows through it constantly. In a normal year, you can dip a bucket in at any point and pull out what you need. The flow is so steady that no one thinks about where the water is. They just think about how much is flowing. That's how the copper market worked for decades. Annual production was large enough and demand was predictable enough that the market could operate on flow. Buyers didn't need to hold inventory. They could rely on the fact that when they needed copper, copper would be there. But now imagine the river is being dammed in 3 places upstream. The total water is the same, the flow rate is the same, but the water that reaches your bucket is no longer the water that enters the river. It's whatever the dams release. Those dams, in copper, are called strategic reserves, long-term supply contracts, and vertically integrated procurement. Here's the critical point. When BlackRock says copper is the new oil, they are not saying copper is valuable, they are saying copper is strategic. And when a commodity becomes strategic, the largest buyers stop participating in the spot market. They lock up supply years in advance. They build their own pipelines. They sign take-or-pay agreements that remove tons from the market before those tons ever see a price. The copper that remains, the copper that trades on the London Metal Exchange, the copper that sets the price everyone else sees, is the residual. It's what's left over after the strategic buyers have already taken their share. And that residual is shrinking. Let me explain what I mean when I say availability is different from production. Imagine a river. Water flows through it constantly. In a normal year, you can dip a bucket in at any point and pull out what you need. The flow is so steady that no one thinks about where the water is. They just think about how much is flowing. That's how the copper market worked for decades. Annual production was large enough and demand was predictable enough that the market could operate on flow. Buyers didn't need to hold inventory. They could rely on the fact that when they needed copper, copper would be there. But now imagine the river is being dammed in 3 places upstream. The total water is the same, the flow rate is the same. But the water that reaches your bucket is no longer the water that enters the river. It's whatever the dams release. Those dams, in copper, are called strategic reserves, long-term supply contracts, and vertically integrated procurement. Here's the critical point. When BlackRock says copper is the new oil, They are not saying copper is valuable. They are saying copper is strategic. And when a commodity becomes strategic, the largest buyers stop participating in the spot market. They lock up supply years in advance. They build their own pipelines. They sign take-or-pay agreements that remove tons from the market before those tons ever see a price. The copper that remains, the copper that trades on the London Metal Exchange, the copper that sets the price everyone else sees, is the residual. It's what's left over after the strategic buyers have already taken their share. And that residual is shrinking. Let me give you the numbers that matter. Global refined copper production in 2024 was approximately 25.8 million tons. Consumption was 26.2 million tons. That's a deficit of 400,000 tons. Not large. The market has run deficits before. Deficits can be covered by drawing down inventory. But here's where it gets interesting. Total reported global inventory, LME warehouses, Shanghai futures, exchange warehouses, COMEX warehouses, all of it combined, is currently sitting at 420,000 tons. Read that again. The annual deficit is almost equal to total global inventory. That means if the deficit continues at the same rate, and if no new supply comes online, reported global inventory goes to zero in approximately 12 months. Now, it won't actually go to zero. That's not how markets work. Long before it goes to zero, price will spike high enough to destroy demand somewhere. Some factory will shut down, some project will get delayed, some buyer will simply not get their copper. But here's the part that matters. The 475,000 tons of AI-related demand arriving in 2026 is not price sensitive. It cannot be destroyed by higher prices. It is not optional. This is where the math stops working. Let me explain why AI demand is different. When copper prices rise, normal industrial demand responds. Construction slows down. Appliance manufacturers substitute. Automotive projects get delayed. This is called demand destruction, and it's the mechanism that has balanced the copper market for 100 years. But AI infrastructure does not respond to price. When Microsoft or Amazon or Google or Meta commits to building a data center, they are not making a discretionary investment. They are making a competitive necessity investment. The cost of the copper in that data center is a rounding error compared to the cost of being 12 months behind a competitor in AI deployment. If copper costs $3 a pound or $9 a pound, the data center gets built. The only question is whether the copper is available. And the copper that goes into AI infrastructure is not interchangeable with the copper that goes into a washing machine. AI data centers require very specific grades, very specific delivery windows, and very specific locations. You cannot substitute. You cannot delay. You either have the copper or you do not build the facility. This is what strategic demand looks like. It does not negotiate with the market. It takes from the market, and the market has to figure out who doesn't get the remainder. Hold that thought. The official story you will hear goes something like this. Copper supply is tight, but the mining industry is responding. New projects are coming online in Chile, in Peru, in the Congo. Recycling rates are increasing. Substitution with aluminum is reducing intensity in some applications. The market will rebalance by 2027 or 2028. And in the meantime, prices will remain elevated but manageable. This is the story told by analysts who cover mining equities. It is the story told by corporate executives on earnings calls. It is the story that justifies current prices. And it is wrong. Not because the facts are wrong. The facts are correct. New projects are coming. Recycling is increasing. Substitution is happening. It is wrong because the timeline doesn't match. Here's why. A new copper mine takes, on average, 16 years from discovery to first production. Not 16 months. 16 years. Permitting alone takes 4 to 7 years in most jurisdictions. Construction takes another 3 to 5. Ramp up to full production takes another 2 to 3. The mines that will produce copper in 2026 were discovered in 2010. The mines that are being discovered today will produce copper in 2040. There is no supply response that can arrive in time. Now, let me walk you through what's actually happening beneath the surface. The copper market operates on a system of contracts, warehouses, and intermediaries that most people never see. Let me break it down layer by layer. At the bottom layer, you have mines. Mines produce concentrate, rock that contains copper along with other minerals. This concentrate gets shipped to smelters, where it is refined into pure copper metal. Here's the first dependency. Most large mines do not sell copper. They sell concentrate, and they sell it under long-term contracts to specific smelters. These contracts are typically 5 to 10 years long, with fixed tonnage commitments. The mine doesn't care what the spot price of copper is. They're getting paid based on the terms of a contract signed in 2019. This means that when you look at a mine's production numbers, you cannot assume that production is available to the market. Most of it is already committed, already spoken for, already flowing through a pipeline that does not touch the spot market. Stay with me. At the next layer, you have smelters. Smelters take concentrate and produce refined copper. They sell this copper to fabricators. the companies that turn copper metal into wire, pipe, sheet, and components. Here's the second dependency. Smelters are not charities, they are businesses. And their business model depends on a spread called the treatment charge and refining charge, TCRC for short. This is the fee they charge to process concentrate into metal. When concentrate supply is tight, smelters compete for feedstock by lowering their TCRC. When it gets too low, smelting becomes unprofitable. And when smelting becomes unprofitable, smelters cut production, even if copper prices are high. This is exactly what is happening right now. TCRC rates have collapsed to their lowest levels in over a decade. Multiple smelters in China have announced production cuts. One major facility in Zambia has reduced output by 30%. So even though copper prices are elevated, refined copper output is falling because the economics of refining no longer work. This is a supply chain that is failing at multiple points simultaneously. At the next layer, you have warehouses. These are the physical facilities where refined copper sits waiting for delivery. The LME operates a network of approved warehouses around the world. When you buy a copper futures contract and hold it to expiration, you receive a warrant, a claim on copper in one of these warehouses. Here's the third dependency. Warehouse inventory is not the same as available inventory. A significant portion of the copper sitting in LME warehouses is already owned. It's being held by traders, by banks, by industrial users who are storing metal rather than consuming it. It's not for sale, it's not available, it's just sitting there, counted in the inventory statistics, but functionally removed from the market. This is called invisible inventory. And when you subtract invisible inventory from reported inventory, the actual available copper is far lower than the headline number suggests. How much lower? Industry estimates vary, but the most credible analyses suggest that true available inventory is somewhere between 100 and 150,000 tons globally. That's 5 days of global consumption. 5 days. Now, let me add the layer that changes everything. The copper market also has a paper component, futures, options, swaps, and other derivatives. These instruments allow buyers and sellers to manage price risk. A wire manufacturer can lock in their copper cost 6 months in advance. A mining company can hedge their revenue. A speculator can bet on direction. In a normal market, the paper market and the physical market stay connected. Arbitrage keeps them aligned. If futures prices diverge too far from physical prices, someone will buy the cheap one and sell the expensive one until they converge. But arbitrage requires two things: capital and availability. You need capital to hold the position while waiting for convergence, and you need availability to actually deliver the physical copper if the trade goes against you. Here's where it turns. When physical availability gets tight enough, the arbitrage breaks down. Market makers who normally keep the paper and physical markets connected start pulling back. They reduce their positions. They widen their spreads. They stop providing liquidity. This is not theoretical. This is already happening. The spread between LME copper futures and physical copper premiums has widened to levels not seen since the supply shocks of 2021 and 2022. The market is telling you that paper copper and real copper are no longer the same thing. And when paper and physical decouple, the price on the screen stops, meaning what you think it means. Now, I need to explain the assumption that everything depends on. The entire copper market, the pricing, the contracts, the hedging, the trading, is built on a single assumption, that the market clears. What does that mean? It means that at some price, supply and demand balance. It means that price is a reliable signal. If price goes up, supply increases and demand decreases until they meet. If price goes down, supply decreases and demand increases until they meet. This is the foundational assumption of every commodity market. It's taught in every economics textbook. It's embedded in every trading algorithm. It's the basis of every risk model, and it no longer clears. Here's why. For the market to clear, both supply and demand have to be price sensitive. But we've already established that AI infrastructure demand is not price sensitive. It does not respond to higher prices. It takes what it needs. We've also established that supply cannot respond in the relevant time frame. New mines take 16 years. Smelter capacity is constrained by economics. Inventory is already at critical levels. So what happens when you have demand that won't decrease and supply that can increase? The market doesn't clear. Price stops being a balancing mechanism. Instead, price becomes a rationing mechanism. This is a completely different market structure, and almost no one is positioned for it. Let me walk you through what a rationing market looks like. In a clearing market, everyone who is willing to pay the market price gets supplied. The price adjusts until supply and demand balance, and everyone walks away with what they came for. In a rationing market, not everyone gets supplied, regardless of what they're willing to pay. The price can go to infinity, and there still isn't enough copper. Something has to give. What gives is the marginal buyer. Someone doesn't get their copper. Someone's factory doesn't get supplied. Someone's project doesn't get built. And the decision about who doesn't get copper is not made by the market. It's made by whoever controls the allocation. In oil, this is called allocation risk. It's why countries maintain strategic petroleum reserves. It's why oil contracts include force majeure clauses. It's why the phrase energy security means something beyond price. Copper has never had this. Copper has always been a clearing market. There has always been enough copper for everyone who wanted it at the market price. That assumption is ending. Now, let me walk you through the stress test scenario. Start with the baseline. In 2025, global copper consumption is approximately 26.5 million tons. Production is approximately 25.9 million tons. The deficit is 600,000 tons. Inventory drawdown covers the gap, but inventory falls to under 200,000 tons by year end. Now add the new condition. In 2026, AI infrastructure demand adds 475,000 tons. Electric vehicle production adds another 300,000 tons. Grid modernization adds another 200,000 tons. Total demand increase, just under 1 million tons. Supply increase, maybe 200,000 tons from existing project ramp-ups, maybe another 100,000 from recycling gains. Net new deficit, approximately 700,000 tons. But wait, we started 2026 with under 200,000 tons of inventory. The math doesn't work. This is not a stress scenario. This is the baseline scenario. This is what happens if everything goes exactly as currently projected. Here's the nonlinear outcome. When inventory approaches zero, price does not rise linearly. It spikes discontinuously. This is because the market shifts from managing flow to managing panic. Buyers who were waiting for prices to come down suddenly rush to buy before prices go higher. Hedgers who were short suddenly need to cover. Producers who were forward selling suddenly stop, waiting for better prices. All of these behaviors are individually rational. Collectively, they create a feedback loop that can move price by 30 or 40% in a matter of weeks. This is what happened in nickel in March 2022. Price doubled in 2 days. The LME had to halt trading. Billions of dollars of contracts had to be torn up. The copper market is larger and more liquid than the nickel market. But the physics are the same. When inventory goes to zero, price loses its anchor, and there is no mechanism to restore it until demand is destroyed, violently, unexpectedly, and somewhere that wasn't prepared. Let me give you a physical analogy for what happens next. Imagine a dam holding back a reservoir. The dam has a spillway, a controlled outlet that releases water at a steady rate. As long as the reservoir stays below a certain level, the spillway handles the overflow. Everything stays calm. But if the reservoir rises above the spillway capacity, water starts going over the top of the dam. And water going over the top is not the same as water going through the spillway. It erodes the dam itself. It creates channels that grow wider. It turns a controlled release into an uncontrolled breach. The copper market's spillway is inventory. As long as inventory exists, price shocks are absorbed. Buyers draw down inventory during shortages. Sellers build inventory during surpluses. The system flexes. But when inventory goes to zero, the spillway is gone. Every shortage goes directly into price. Every buyer who can't get copper becomes a forced bidder. Every short position becomes a potential default. The dam doesn't just overflow, it starts to fail. Now let me show you the split reality that's already forming. There are now two copper markets. They have the same name. They report the same headline price, but they are not the same thing. The first market is the paper market. This is where financial players trade futures and options. It is liquid, transparent, and accessible. It sets the price that appears on screens around the world. The second market is the physical market. This is where actual copper changes hands. It is opaque, fragmented, and increasingly disconnected from the paper price. The premiums charged in this market, the additional cost above the futures price to actually get copper delivered, are reaching historic levels. Here's the divergence. In a normal market, the premium to get physical copper delivered is $5 to $15 per ton. Today, in certain locations and grades, the premium is over $200 per ton. That's a 15-fold increase in the cost of actually getting copper versus simply owning a futures contract. Why does this matter? Because almost everyone who tracks the copper market is watching the paper price. The paper price says copper is around $4.30 a pound. That sounds manageable. That sounds like the market is functioning. But the real price, the price to actually receive copper that you can use in a factory, is $4.30 plus a premium that varies by location, by grade, by delivery window, and by who you are. If you're a large strategic buyer with long-term contracts, you're paying close to the paper price. If you're a small buyer trying to source spot copper, you're paying a significant premium on top of that, if you can get it at all. This is the split. The price everyone sees is not the price everyone pays. And this split is widening. Now I need to talk about convergence. In markets, divergences don't last forever. Eventually, paper and physical prices have to meet. The question is not whether they converge. The question is which one moves. There are two possibilities. In the first possibility, the paper price rises to meet the physical price. Futures spike. The headline number that everyone watches catches up to the reality that physical buyers are already experiencing. This is disorderly but transparent. Everyone sees it happening. Everyone adjusts. In the second possibility, the paper market breaks. Futures stop being deliverable. Contracts get cash settled at prices that bear no relation to physical reality. The market fragments into bilateral deals that never see a public price. The first possibility is a price shock. The second possibility is a market failure. Both are now structurally possible. Let me walk you through the three outcomes. The first outcome is the impossible outcome. This is where supply magically appears, demand magically slows, and the market rebalances without significant price disruption. For this to happen, you would need new mines to come online in 18 months instead of 16 years, AI infrastructure build-out to pause or slow dramatically, electric vehicle adoption to plateau, and grid modernization to be delayed globally. None of these are happening. None of these are even being discussed as possibilities. I assign this outcome a probability of less than 5%. The second outcome is the disorderly outcome. This is where inventory goes to zero, price spikes discontinuously, and the market experiences a genuine crisis. Contracts default, trading halts, physical buyers are rationed, industrial production is disrupted. In this scenario, copper becomes a genuine strategic concern at the national level. Governments start talking about stockpiling. Trade restrictions appear, the market never fully returns to its previous structure. I assign this outcome a probability of approximately 30%. The third outcome is the managed outcome. This is where price rises significantly, but in a relatively controlled manner. Strategic buyers lock up supply. Marginal demand is destroyed in price-sensitive sectors. Industrial users substitute where they can. The market rations itself through price rather than through chaos. In this scenario, copper prices reach sustained levels that would have seemed impossible 5 years ago, perhaps $7 or $8 per pound, and stay there for years while supply eventually catches up. I assign this outcome a probability of approximately 65%. Notice that all three outcomes involve significantly higher prices. The only question is whether the price discovery happens in an orderly or disorderly manner. Now let me tell you what this means if you're watching. This is not financial advice. This is not a recommendation. This is a description of structural conditions and what they mechanically imply. If you are an industrial user of copper, your procurement strategy needs to change. Spot purchasing is no longer reliable. Long-term contracts and physical inventory are now risk management tools, not cost centers. If you are an investor in companies that depend on copper, you need to understand their exposure. A company that manufactures electrical equipment but has no copper hedging strategy is exposed to input cost volatility that could eliminate margins. If you are an investor in copper producers, you need to understand that elevated prices do not necessarily translate to elevated profits. If a miner has forward sold their production at lower prices, they don't benefit from spot price increases. And if they haven't hedged, they are exposed to operational risks that become more severe in a tight market. If you are simply trying to understand what is happening in the global economy, copper is the tell. More than oil, more than semiconductors, more than interest rates. Copper is where the energy transition, the AI revolution, and the infrastructure deficit all converge. Watch copper. What happens here will happen elsewhere, in other markets and other commodities, on different timelines. This is the preview. Here are the indicators to watch. First, watch LME inventory. When it falls below 100,000 tons, the market is in critical condition. When it falls below 50,000 tons, the market is in crisis. Second, watch the Yangshan premium, the premium for physical copper delivery in Shanghai. This is the closest thing to a real-time indicator of physical tightness. When it spikes above $100 per ton, something is breaking. Third, watch TCRC rates, the treatment and refining charges that smelters receive. When these approach zero or go negative, smelter economics are failing and production cuts will follow. Fourth, watch the cash to 3 months spread on the LME. This is the difference between the price for immediate delivery and the price for delivery 3 months out. When the spread goes deeply negative, called backwardation. The market is saying that copper today is worth dramatically more than copper later. That's a sign of physical tightness. Fifth, watch any announcement of production cuts from major mining companies. When producers voluntarily cut production in a high price environment, something is structurally wrong. None of these are predictions. They are observations. They are the numbers that will tell you, in real time, whether the stress scenario is unfolding. Now let me zoom out. What is happening in copper is not an isolated event. It is a preview of a broader phenomenon, the collision between financial markets and physical constraints. For 40 years, financial markets have operated on an assumption of abundance. Any resource can be acquired at the right price. Any constraint can be engineered around. Any shortage is temporary. That assumption is now being tested simultaneously across multiple domains. In copper, the test is AI demand colliding with geological constraints. In energy, the test is electrification colliding with grid capacity. In labor, the test is automation colliding with demographic decline. In capital, the test is sovereign debt colliding with interest rate normalization. Each of these is a story unto itself, but they share a common structure. They are all situations where the financial narrative has decoupled from the physical or demographic reality. Markets are very good at pricing information. They are very bad at pricing transformation. They are very bad at pricing phase transitions. They are very bad at pricing the moment when a system that has worked for decades stops working. Copper is the leading indicator, not because copper is the most important commodity, because copper is where the mismatch between narrative and reality is most advanced, most measurable, and most imminent. What happens here will teach the market how to price the rest. I want to end with something that BlackRock understands better than almost anyone. When they say copper is the new oil, they are not making a commodity comparison. They are making a strategic comparison. Oil was never just a commodity. Oil was power. Oil was leverage. Oil was the ability to shape geopolitics, to influence policy, to determine which economies rose and which economies fell. Copper is becoming the same thing. The countries that control copper supply will have leverage. The companies that secure copper access will have advantage. The investors who understand copper mechanics will see what others miss. This is not a trade. This is a structural shift. And structural shifts, by definition, do not reverse. The mines that will produce the copper of 2040 are not being discovered fast enough. The infrastructure that will consume the copper of 2030 is already under construction. The gap between those two realities is widening every month, and no policy response can close it in the relevant time frame. The question is not whether copper becomes strategically constrained. The question is not whether prices reach levels that were previously unimaginable. The question is not whether the market structure changes permanently. Those are already determined. The only question is how long it takes for the price on the screen to reflect the reality on the ground. And the answer to that question is not years, it's quarters. The clock is running. Thank you for your time and attention. If you found this analysis valuable, your subscription supports more work like this. If you have questions or observations, the comments are open. This is not financial advice. This is mechanics, consequences, and timing. The copper story has begun. Now you understand how it unfolds.